If you've ever felt intimidated by investing, or sometimes you've thought investing is not for me, it's for the rich, this episode is for you. Today, we are discussing all about Investing 101, where and how to start so you can grow your money and build your wealth over time. And to join me today, we have got our very own Edem, the expert, financial expert, coach, and author, who is here to share practical strategies for beginners or someone looking to start their investing journey, or a pro who wants to make better decisions and choices. Before we dive in, don't forget to like, subscribe, and comment on your biggest investing fear or question. Let's get into it. Welcome to B3 Inspire once again.
Thank you for having me.
5.
I know,
Yay.
we get it.
Now, let's start with the basics. What are the key difference between stocks, bonds, and index funds?
So, a stock pretty much is you buying a share in a company.
Okay.
So by buying a share in the company means that you're going to own a portion of the company.
That sounds good.
You're gonna have a stake in the business. So that's why they call it a shareholder, because you become a stakeholder. So what happens is that your money grows as the company grows and as does well over time. And because you are investing or buying a share in that one company, sometimes or most of the time it's more risky. Okay. But that's pretty much the basis of share or buying share of a company. Then when we talk about bonds is essentially lending money to a company or to a business with the view that there's going to be a predetermined interest or predetermined return called coupons at the end of a certain period. So when, for example, you get at the end of 1 year, it means that the company or the government whom you've lent money to is going to give you maybe 5% as a coupon or as the return, or they call it more of an interest really on the money that you lent to them. Then lastly, when we're talking about index funds, index fund is really a basket of funds, a basket of stocks, a basket of shares, depending how you want to look at it, of a company. Now, sometimes you realize that on TV, you will see things like FTSE 100,
S&P 500,
you see the Nasdaq.
That's right.
You see the Dow Jones.
So those jargons, like, what's all this about?
So these are basket of stocks, really much. So what happens is that for beginners who are really beginning their investing journey, I would always recommend the index fund, because when you buy the index fund, it means that instantly you have diversification, because it's different companies all pulled together so that you can buy a unit or a portion of those different companies in that one fund.
You spread the risk
accordingly.
Wow. So if someone is just starting out, which of these options would you recommend, or would you say is best for them?
Yeah, so if somebody is a beginner starting, I'll recommend the index fund.
Okay.
Index fund, as mentioned previously, when you invest or you buy an index fund, you instantly will have access to diversification. Instantly, you have access to low fees. And also over time, it grows for you as well, without you necessarily having to worry about, oh, should I sell? Should I buy? Is the market moving up? Is the market moving down? What should I do? So what happens is that because index fund, you are buying into a basket of companies or stock in there. As the market is going up, what the index fund is that it tracks an index. Remember that the fund itself is not the index. The fund tracks the index. Very important. So as the index or S&P 500, Dow Jones or FTSE goes up, because the fund is tracking the S&P 500 or the Dow Jones or FTSE, it means that if the fund, the index is going up, your money or your investment also goes up. So whatever the market or the index does, that's what your fund or your investment also will do.
Excellent. Thank you for explaining those three. So we have got the difference between stocks, and of course we've got bonds, and then we've got the index funds. And you recommend that if someone is just beginning their investing journey, then maybe the safest way to start is the index fund.
That's correct.
So let's talk about the magic of investment, which is the compound interest. So how does it really work, and why is this such a powerful wealth building tool?
So compounding or compound interest, how it works is that when you invest your money,
yes,
your money does not only, or your initial, what we call the principal,
yes,
it does not only earn interest, but the interest will earn interest, and then your initial money will also earn interest.
Golden hen lay the eggs, the eggs then become a chick, grow to be a hen, and also lay chicks. And it's like, more babies, more family. Okay.
And get bigger and bigger.
And
over time, it grows exponentially, because it is just compounding, interest upon interest upon interest, and not just on the interest, but also on your principal.
Amazing. Can you give us an example of how compound interest can impact on someone's savings?
Yeah, absolutely. So let's say an example, you are to invest, let's say £250 per month.
Okay.
£250 a month, earning you an interest of, let's say, 8%.
Yeah.
8% over 30 years, compounding over time, that would become 250,000 over that 30 years. Wow. But then, if the same £250 earning 8% is invested for only 20 years, so basically that means you started 10 years later, for 20 years, that £250 will become 100,000. That is huge amount of difference in terms of the amount that you would have lost just by missing out that 10 years. I mean, just by missing out 10 years, the difference is of 150,000.
That's huge.
Yeah, and that's even not maybe starting 15 years later. It's just 10 years, and just the 10 years, you would have lost out more than half.
That's amazing. So the key takeaway is start early and stay consistent.
Absolutely. That is the key when it comes to investing, when it comes to compounding. Consistency is key. It's not so much about timing the market, it's about time in the market.
Time in the market.
So staying in the market, investment will go up and down. That's normal. That's investment. But staying in there and not coming out, and then basically investing at different points of the investment curve, which will come over a bit later. It means that over time, you will not miss out on any long-term growth of the investment.
Excellent. Well, Edem, now let's talk about strategy.
Yeah.
So what are some of the investment approaches that beginners should consider?
So think about what we call pound cost averaging. So pound cost averaging literally is about investing fixed amount of money over time consistently. So let's say if you are to be investing maybe £100 a month, £100 a month, make sure that you are consistent with that £100, irrespective of how the market or the news, the economy, keep putting in that £100 over the long term. And what you're doing is that, and I mentioned this earlier on, and that's what it is. It's what we call pound cost averaging. Investing your money means that you are buying at a different point of the investment curve. And over time, it means that you are smoothing out your investment, so that if there is an upwards turn in the investment, over the investment horizon, it means that your money is going up. If there's a downward turn, the money that you would have invested up there means that that money will sustain value within your investment portfolio. So buying at different point of the investment curve just goes a long way to maintain value for you. And the other thing as well, quite a principal investment strategy is probably my favorite, but it's a cliche, but you buy low and you sell high. The only way to really capture that strategy by not really worrying about, when should I invest, when should I not invest, is by pound cost averaging, by investing regularly over time, irrespective of what is happening on the market. Because at some point you're buying low, and as the market is going up, with the bit that you bought low is what will really give you a huge gain in the investment and in your portfolio. So that's one. And number two, it's what we call diversification. I've mentioned it before. It's a terminology which is very important when it comes to investment. I mean, you cannot go wrong with diversification. Diversification is quite principal when it comes to investment. And diversification means that, in simple terms, not putting all your eggs in one basket. Yeah. That's what it is. It means that you are spreading your risk. That's right. It means that you are investing and putting your money in different places at different times. And what are those different places? It means that you are putting your money in different asset classes. What are these asset classes? Asset classes, we're talking about equity, which are shares, we're talking about bonds, which we talked about. We're even talking about things like properties. We're talking about cash as well. And we're talking about things like commodities, like gold, like silver, precious metal. Even nowadays, you can even buy what we call flakes, like snowflakes. People are investing in snowflakes as a commodity. Amazingly, you can have a market for anything on the stock market. So investing in these different asset classes is one way of diversifying. Another way of diversifying your portfolio is investing in different geographies. Yeah. So investing, for example, put your money not just in America, which is one geography, but also in Europe, or maybe in the UK, or maybe in Africa. Yes. So different regions, and very important. And the other way of diversifying is in diversifying across different sectors. So we're talking about healthcare, we're talking about utilities, we're talking about education, the consumables. So different sectors. It means that if you are diversifying in these different areas, you have a good spread of your money, so that no matter what's happening in one economy or one geography or with one asset class, it means that you don't really have to worry about, am I going to lose money? Am I not going to lose money? Over time, staying there for a long time means that you're gaining value because of diversification, and you are minimizing your risk. And the last thing I want to talk about is really about investing for the longer term. Investing for the longer term. I mean, normally people say, "Oh, damn, how long should I be putting my money in there for?" I mean, should I invest for 1 year, 2 year, 3 year? Yes. But when it comes to investing, we say minimum 5 years. Yeah. Think about 5 years as sort of the minimum sort of time when you should be looking to invest in your money. Anything above the 5 year period is a bonus. Why do we say 5 years? Because within the 5 year period, it means that the effect of inflation, the effect of interest rate, the effect of taxation, all of those would have taken effect. So the actual return that your portfolio will be enjoying will be what we call the net return. So or what we call the real return. All of those very different variables, which sometimes they call it the enemies of investing, would have really your portfolio would have really ironed all of them out. So for the longer term, rather than for the short term, 5 years, if for any reason you have to invest for maybe 3 years, 4 years, make sure that you speak to a professional who might recommend something that is really appropriate for your risk profile. And talking about risk profile, it's another important thing. Always, when you're investing, make sure that you are investing as a minimum according to your risk profile. Your risk profile is not the be and all of it, but it's a guide to know how you should be investing, what kind of portfolio you should be investing in, what sort of asset class you should be choosing for diversification, what sectors you should be using, and even what sort of geography you should be investing in. But it's all sort of quite fundamental, looking at your risk profile as a starter.
And this is where you need the expert's advice.
Yes, so very important. If you can't do it on your own, yes, please seek the advice of an expert or a professional who can guide you through it.
And Edem's details are below this video if you would like his company to support you in making some of these very important decisions, but can be scary if you are starting at first. Excellent. That really makes sense. So far, for someone starting, let's say someone that's based in the UK, which investment platform would you recommend or can they use?
So for UK, for a beginner, I mean, there's quite a lot of them out there actually at the moment. For a beginner, I would say perhaps they could utilize platform like maybe Moneybox, just to test it how it works, because they've got sort of built already sort of built portfolios out there for you. Moneybox, Wealthify, Plum, so it's good. Nutmeg is also a good one as well. So you can utilize these platforms to help you to invest. If you want to do yourself because you've got the knowledge, you're capable, you feel that I can sort of go out there and do on my own. You can utilize maybe Hargreaves Lansdown or AJ Bell, Best Invest, Fidelity, even Aviva. They've also got platform as well that you can utilize. And if you're looking at for the long term, maybe for your pension or retirement, you can utilize, again, AJ Bell has got a good platform. They call it Invest Center. Normally, they want a professional to come alongside you if you're investing for your pension, just because of the law, the tax laws and the features that comes with it. A platform like Transact is also good. Interactive Investor is also a good platform if you're looking at retirement and also for pension investments.
Wow, that's a lot to choose from. If you have found this video helpful, just to remind you, like it, share it with someone else who might benefit from this insight, and don't forget to subscribe to B3 Inspire. A lot of people are afraid to invest because they worry about losing their money. How can they overcome this fear?
Good question. So fear is normal, or being afraid is normal when it comes to investing.
So hard-earned.
Hard-earned money, it's so true. But so not taking risk is a risk. Simply put it
like that.
Not taking risk is a risk on its own. Even when you think that your money is put your money in a bank account or in a savings account, that is a risk. Or even putting your money under the mattress or a pillow is a risk, because there's something called inflation. Inflation, what inflation does is that it shapes up the value of your money by not investing it, by not making sure the money is working for you. So making sure that your money is working for you is so critically important. So just take the step. And
feel the fear and do it anyway. We've said this over and over on B3 Inspire.
One of the things, absolutely, yes. And one of the things I've learned, I mean, generally when it comes to life, is over how to overcome your fear.
That's right.
Is always to do the opposite of that fear.
That's right.
Very important. So to do the opposite of that fear, master the courage, master the bravery, and then take that step. Take that. You will not know until you have taken that step.
Totally.
And with a multitude of counsel, there's victory. Remember,
victory.
So if you don't know how to do it on your own, just get the help of somebody who can come alongside you to guide you, to help you to do it. And taking that step means that, again, and this is another important point as well, start small. If you feel that, oh, this is not for, I don't know, I'm not sure about this, start small. Start with £50 or £20 even. And now some of these platforms you can start with as minimum. Actually, the minimum as £25. So with £25, that's small, you could be investing, and over time you increase it. So start from where you are, start small, overcome that fear, and think about the long term.
The compound interest.
Absolutely. And that's what.
Such a good feeling.
I think it was Albert Einstein, I said the compound interest was the seventh or eighth wonder of the world. You can't go wrong with compounding because when you stick in there, and the potency of the long term is being consistent. Consistency is very important. Staying there for the long term ensures that you are reaping the benefit of that marginal efforts and that marginal action that you're taking for the benefit of growing your money for the long run
and achieving those goals. That's great advice. Now, I am just going to talk about what books, because I do believe all of this fear of starting and worry, all of that, it's all about mindset. So maybe a resource, a book that we could recommend that would help people towards, that overcome that fear. Should I start? I think they're probably going to guess what I'm going to say. The Money Psychology by Morgan Housel. I've talked about it so many times on here. Yes, would be one that I would recommend. Yes.
It's a good one, actually. And then you could also, there's one called The Intelligent Investor by Benjamin Graham. It's a good book, actually.
Oh, I've not read that one. That's going on the summer list.
Then there is also The Simple Path to Wealth by J.L. Collins. It's a good one too. And then Robert Kiyosaki's book,
Rich Dad, Poor Dad.
It's a good one. For investing, for business, and for mindset, and just taking the right action. So these are a few books. I believe that if you do start with these ones, you cannot go wrong. There's so many of them.
Amazing.
The Millionaire Next Door.
The Millionaire Next Door.
It's a good one as well. The Secret of the Millionaire Mindset. It's also a good one. So it's quite a few ones.
Countless. Excellent. What a great place to start. Remember, it's about starting. Start small and be consistent. And then you enjoy the compound interest. And in all of this, remember, B3 Inspire. Pay yourself first. This has been an incredible discussion. Oh my goodness, so much to learn from. But before we wrap up, Edem, what is the one final tip for our new investors?
Okay, so again, let me use the arrows. Okay, and this is what I mean. When in the previous series, I mentioned about the return on emotions. Okay, and when it comes to investing, please avoid the return on ego. Very important.
Return on emotions for savings, return on ego.
Very important.
Break that down.
So some people want to just go out there and then buy rather than invest because they want to achieve that status of that class in society.
Own a piece of that business. Oh, I see.
That flash,
those big brands,
that big brands, that the flashiness that comes with it, because I've got a certain status in society, and so why should I invest my money or put it that way for 5 years when I've got a status to maintain, I've got an ego to maintain. People know me as a chief, as the CEO, or so. Why should I maybe buy a Toyota when I can buy a Range? And because I've got an ego. But people, and I keep on saying it. You are don't live to please anyone. Stay in your lane.
That's right.
The return on investment outweighs the return on ego. So please avoid the return on ego and go for the return on investment. Start right where you are. Start small. Think about the long term and be consistent.
Wow. Love that. Just let's recap today's episode. So we've talked about stocks, bond, index funds, and each serve a different purpose. We've discussed at length about compound interest is key to growing your wealth over time. Start now and be consistent.
Absolutely.
And the best investment strategy for beginners include the pound cost strategy. Is that right? Is that pound cost averaging?
Pound cost averaging, that's right.
Yes, and diversification. And of course the long-term thinking.
Absolutely.
Okay. and overcome your fear by starting small and thinking long term. What's next? Episode 6. Oh my God.
It's all happening.
What's happening? Right, we are talking everything about managing debts and loans.
Yeah.
Like a pro.
Absolutely.
Ooh,
and we're going to
wow.
focus a bit more on the students' loan side of things, and which is one of some of the biggest loans that anyone who has gone through education in the UK or even America, Canada, wherever you are, students' loan is a biggie. But so
it's a big one. It's a necessary evil.
Yeah, so we're going to look at all of that. Bad debt, good debt, what are they? And then how best do you position yourself to make the most on your money.
Amazing. And we will cover how to pay debt off using strategies, isn't it?
Absolutely.
Amazing. And avoid that financial pitfalls.
Yes.
Excellent. I can't wait.
Yes.
But before you go, like this episode if you have found it helpful. Subscribe for more information. The series is getting even more exciting and more juicy. You don't want to miss out. Share with someone who needs it and drop a comment. What is stopping you from investing? Thank you for tuning in again, and remember, build your foundation, believe in your potential, and become